and welcome to Investors Hangout, this fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, one dilemma that most mutual fund investors face is when is a good time to sell a fund? While some want to exit a fund simply because they've made enough money, there are others who want to get rid of it because of underperformance. But to help us make the right decision at the right time, we're joined by our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Now, a lot has been said about the benefits of investing in mutual funds and why one should start as early as possible. But it is comparatively difficult to find advice about when should one exit a fund. Many of our viewers have been writing to us wanting to know if this would be the right time to exit with the markets on a high right now. So what would be your advice to them?
I would say that, whenever somebody is asking me that is it a good time to buy, exactly in the same manner people are asking is it a good time to sell. I don't think, the state of the market should be the driver of whether you should buy or not, or whether you should sell or not. So exactly for the same reason, just because the market has gone up, you should not consider selling. You should definitely sell if you think, you are investing for a goal, and because of the appreciation, you can achieve that goal. You have enough money to buy something or spend on something which you are planning to take your money out. There is another reason why investors should sell, when investors should sell, which is, you started investing in a good fund, and after you started investing, or you continued investing, you are realizing that this is no longer a good fund. All the things that you thought about that fund is no longer true. It has stopped doing well, and it is not behaving the way it was supposed to, or to your expectation, and you are able to understand that reason. So that is another reason why you should sell. The third reason is that when you need the money, but just because the market has, everybody thinks that the market is at a high, the market is is poised for a big correction or can come down dramatically. That is not a good enough reason, because by that yardstick, I have come across, at Value Research, so many investors write their, post their questions, write mails, and so many investors I have come across who have actually sold their investment in the last 1.5 year or some time, and now they are waiting for that correction, and that correction never happened. And we have seen the big moves of the market happening in the last 1.5 year. Assuming that an investor would have taken his money out at the high levels before the 30% decline in the market in March 2020, and assuming that he was right, and after that, just that if you would not have gotten back into the market, then this would have been one of the biggest missed opportunity. So the opportunity loss on account of mistiming the market, because timing the market perfectly is very difficult, and which means that you are left with the option of being out of the market. And when you are investing in equities, investing for the long run, one has to be ready for a correction, and in fact the correction will turn out to be a good thing. And if you are investing, if you have time on your side, don't even think in terms of selling or trying to perfectly time it. And nobody knows the state of the market. Don't even expect us to give you any guidance on that.
But there are investors who are still fearful. What would be your advice to them? When should they, what should they do and how?
One is that just because the market has gone up and you have invested your money gradually over a period of time, it's quite understandable that one gets scared that just in case the market comes down, one has far less, or relatively new investor. Then if somebody has been investing for the last 5 years and more, I think they would have experienced big declines and they would have witnessed the big surge as well. But anybody who has come in the last 1 year, 1.5 years, and they have been lucky, or they are witnessing this unreal returns, more so given the context that interest rates are so low, or the world has been so scary, and still the investments are up about 50-60%. So understandable that they will be fearful. I think they should do a little bit of work on that front. Work on some kind of rebalancing, some kind of asset allocation. And that could be, to my understanding, there are broadly three kind of asset allocation, equally into equity and debt. Maybe a quarter or a third of your money in equity or debt for the very conservative investor, and a quarter or a third in fixed income for the aggressive investor. So if you are, relatively new investor, you should consider this. One-fourth of your money should be in fixed income. Maybe gradually take one-fourth of your money. So this will not be a very knee-jerk reaction. At the same time, you will feel just in case the market comes down, you will get an opportunity to rebalance again, to be able to buy something at lower levels. And if the market correction does not happen, you will not have deep regret, because a good part of your money, three-fourths of your money or two-thirds of your money, is still invested in equity. So if you have time, work on some kind of asset allocation if you're an investor who is getting nervous. Otherwise, long-term investors, they can do without it if you're fine with the ups and downs of the market. Few things also come to my mind, which one should be conscious of, and that could be, that can also trigger a sell decision. If you liked a fund manager, or if you liked a fund, and the fund manager moves on, I think it's time to worry. It should definitely be on your, you should actually be, the fund should move to your watch list. You should become careful about it. And if it could be a reason when you should sell. There is another reason, the fund company changes, and it is changing hand in a manner that, it is going to be questionable hand, or you are not impressed with that, you are scared of that. Maybe that's another. So, dramatic change in the ownership or the management of the fund. And so these are other contextual thing that can change with the fund, which can when you should consider selling your fund, otherwise not.
Okay, and is there anything that one should be cautious about while selling a fund?
Yes, well, two things which one should be very conscious about, which is particularly, and the tax incidence. Because earlier there was no problem when you're selling your equity funds, all the long-term capital gains was tax-free. But today what happens is, if you decide to change, if you decide to sell and move to some other fund, you are liable for capital gains tax, and that is 10% of your long-term gains. Also, all your gains will be reduced by 10% the moment you sell. And the other is, poor fund. Your understanding of poor fund or a good fund should not be based on a very short-term underperformance or outperformance. One should not choose a fund based on, great short-term performance. And likewise, one should not get out of a fund simply because, the fund has had a bad few months or couple of months or few quarters.
All right, then time now to move on to our viewers' questions. And the first one comes in from Moti Rajendran. He wants to know if you would suggest moving the profit component to a debt fund and leave the capital in equity funds. He's asking this specifically from the perspective of small and mid-cap funds.
No, it entirely depends. I would say that one should work on some kind of a conservative investor. First and foremost, should not be investing in, small and mid-cap funds. And so, one should see the biggest, safety or the relative stability comes from a greater diversification. But just in case you invested in small and mid-cap fund and you have made some handsome gains and you want to really lock in your gains, that does not mean that, moving the gains to a fixed income fund is going to get you any kind of insurance. Simply because, you can take the gains, and the capital which will be left in small cap, if the market corrects, they will fall dramatically. If your capital comes down by 50%, it amounts to the same thing. I think work on your total asset allocation. All the money that is invested in equity across the fund, maybe move a third of it into fixed income. That will make it relevant. Just moving the gains, because the gain component could be very different for different people depending on their age of investment. For example, I have some investment which are 15, 20-year-old. So the capital component, my investment in that investment of the investment value is just about 10%. 90% of it is gains. And so, yeah, it's a very different thing. If you invested a month ago, maybe a year ago, and the fund has gone up by 50%, then only a third of your money is gain. If you invested 5-6 years back, then possibly your investment, your gains could be about 75%. So the scale of gain can be different. I think it is better to, if you are really scared of the market and you have you will have to be very upset if the market comes down dramatically. Work on your total asset allocation and do something about it, not on moving your gains from some of the funds.
Shubham Jain asks, what is your view about the recent Evergrande episode of China? Should he make any changes to his portfolio? Also, will the market crash? He wants to know.
Uh, I will just go in the reverse order. I don't know whether the market will crash or not. And I don't think you should be asking this question because nobody knows. I can tell you with reasonable confidence. The other is that, should you make any changes, something because of the Evergrande episode? No, not at all. It's a very internal issue of China. I don't think it will snowball. It might have some implication for some companies which are supplier of some material which might find some difficulty in America, but in China, but nothing beyond that. Yes, there are some lessons to be taken that the real estate companies world over behave in a very different way, and India has been no. In fact, China should take a lesson from the Indian experience that we have been able to fix so far. Look at the Real Estate Regulation Act. 3, 4 years back, we initiated that, we started that, and it is now beginning to show results. Likewise, Indian banks have started lending more carefully, and they have been deleveraging. Indian banks have reduced their exposure to real estate. Indian banks have become more careful about lending to real estate companies and in a measured way. And as a result of which, there has been a virtual cleaning up of the real estate sector. So I think I don't think we have anything to worry about what is happening in China, and there is a lot of learning for Chinese people on this Evergrande, experience for them to learn from India, the way we have gone about fixing our real estate sector in the last 5, 7 years.
Now, Kaustubh Shamsheri has an SIP in mid-cap fund, which will mature in another 3, 4 months. So, should he renew this SIP after that, or should he stop?
No, one is that he should feel happy about it, and if he doesn't need the money, SIP is not something which is a deposit with a maturity. He can continue, and one should be investing long-term money. And if you're comfortable with the interim declines that you saw in March 2020 or sometime in between, you must carry on. Ideally, an investor, if you're becoming little, worried about your investment simply because it has gone up, not much to worry. If you're still investing for 5 years and more, carry on with your investment. If it is for any shorter period, then maybe move to more conservative vehicles like balanced advantage funds or aggressive hybrid funds and things like that.
The next question has been sent in by Venkata Ramakrishna Kakamanu. He asks how to safeguard his mutual fund investments against a market crash. He only invests through SIPs.
Unfortunately, there is no way to safeguard any investment in equity from a market crash. Whether you have the finest of investments, whether you have the worst of investment, they will all crash. If there is no part of the market which can be insulated in a market crash. The only thing is that you can do something whereby after a market crash, bad companies, bad funds don't make a comeback, or they don't make a dramatic comeback. Good companies, good funds, they make a comeback. So you can do something about it. There is no way you can actually protect yourself against a crash. You can do something whereby you will not be as badly hurt by a market crash.
Amit Sethi wants to know, since the investment in a tax saving fund is locked in for 3 years, is it fine to invest a lump sum, or should one still go with the SIP mode?
Ideally SIP, but this 3 year, and if you can think of 5 years and more, my understanding is that you do SIP primarily to manage your own mental makeup. So from that standpoint, the 3 year lock-in comes in very handy. And if anybody is going to invest in tax saving fund over the next 10, 15, 20 years, and if you are making an annual investment, that is your SIP. Just the periodicity of it is annual. And because you get locked in, you don't behave in an erratic manner. You don't behave you don't have a knee-jerk reaction to any such decline, which in an open-end fund you normally have. If you see a big decline, you get nervous. So yes, if you have not started investing, you may make lump sum investments, but generally, we earn every month. Why not be disciplined about our investments as well?
Now, Akshay Shah asks, Is this the right time to invest in small cap funds with a horizon of 10 years? And how should we go about it? Lump sum or SIP?
Uh, Small cap fund had a great run in the last 1 year. They are the best performing, equity fund category, and that is the reason why one should not be investing lump sum. For 10 years, if you're fine with the ups and downs of, because small cap funds, when you see the last 1 year return, 3 year return, they look very handsome. They look very compelling. It is very difficult to not invest in them. But what we are missing out is even in the finest of fund, when you see the big decline, they fall very freely when the markets, in case of a market crash, what we saw in 2008, that the small cap funds actually went down by 70-75% in value, whereas the overall market, saw some good diversified funds were down for 30-40% or maybe 50%. So when you see 75-80% decline, how will you feel if your 100 rupee gets reduced to 20 rupees? That is something which you should keep in mind. That is the problem of small cap, or that is the peril of investing in a small cap. In the worst of times, they look horrible. And if you are fine with it, if you'll be disciplined, if you will not behave, if it will not affect you, uh, and you can still stick around and be regular with your investment for next 10 years, invest in them. And one should always be doing, in any such investment, one should always be little regular and steady rather than making a lump sum investment, and more so now.
PC Garg wants to know how many flexi cap, mid cap, and large cap funds would you suggest to create wealth over the long term, say 10 years or more? He has a total amount of about 1 crore rupees to be invested.
I would say, there are different ways of dealing, building a mutual fund portfolio for this large sum of money. And this large sum or small sum is entirely a very relative thing. If this is your lifetime savings, then it is a very large sum. If it is one of your, 1 crore is amount realized from one of your small assets, and it can be invested for the long run, then it's a different issue. So lot goes into approaching your investment and how relevant it is in an individual context. But I'll just give you different ways in which you should build your portfolio. 3 or 4 flexi cap fund to be, and in which there is something, if you have to invest this, if this is a large sum of money for you, then you should definitely spread your investment over the next 18 months to 24, 3 years, depending on if it is depending on the relevance. So 3 or 4 flexi cap fund divided into monthly installments should be the way to go. You will be achieving great diversification across different skill sets, different fund companies, and maybe of which 1 or 2 fund should have some allocation to international allocate stocks as well. If you have to build a portfolio of small cap, mid cap, and large cap, then there are different ways of building it. One is that the large cap can well be represented by a very low cost index fund, and the remaining, that could be 30-40%, and that could be just one fund, because the index fund, you don't get you don't get to choose. Diversification there doesn't matter. You should just go by the largest one and the cheapest one, and that's it. And small cap and mid cap, I think 2 or 3 mid cap and 1 or 2 small cap will actually make it a complete portfolio. So this is another way of building your portfolio. I think the third way of building a portfolio is looking at 2 aggressive hybrid funds which are disciplined with their asset allocation, and that will be a very low maintenance, little conservative, and automatically you don't have to worry about the rebalancing yourself. The money, your all your investment will automatically get rebalanced. Also, the market, the on any market fall, your funds will not fall very dramatically. So that is also a very comforting thing, because we all look at the upside of the equity market, but I think the most difficult phase for any investor is the downside, the falling phase of the market, and that is when it becomes very difficult to stay invested or remain invested. So that is another way, that's a conservative way of looking at investments. 2-3 aggressive hybrid funds. That's the third way of building a portfolio.
Now, what category of funds would you suggest to invest rupees 7,000 every month for 10 to 15 years? Is what Abhishek Kumar wants to know.
It depends on, Abhishek's experience. If you are going to invest for the first time, and if you can actually, by investing this money, you can also save taxes, then maybe a tax saving fund is good enough. And if you keep investing 7,000 rupees every month, it'll get you the tax saving, 3-year lock-in period, and in 15 years, I think it can translate into very sizable sum of money if you're regular about it and don't take your money out. The other way, if you are experienced a little bit, maybe a combination of, an index fund and small and mid cap fund. Half of your money in, a mid and small cap fund, and half of it in large cap, an index fund, a low cost index fund. That's another way of building it, and you can set up your SIP. I think another advice which I would like to, or another suggestion which I would like to make, which most investors actually forget in terms of, we think of our investment in terms of constant, and we miss out on increasing our savings, increasing our investment over time. So maybe, you should do only your annual SIP commitments and revise your 7,000 must go up to by some percent, depending on your rise in income. If you're going to earn little more, then you should also be investing little more.
Vishali wants to know which one among direct stocks and exchange traded funds should be preferred in terms of returns and charges, and which sector do you think will be in focus for the next 5 years?
Very difficult to guess which sectors will be in focus, or which is a promising sector where one should be investing, which I understand is the idea behind this question. I would say that, I'm a believer of diversification. I'm a believer of I have this understanding that it is very difficult to guess because there are just too many moving parts. What will drive which part of the market? But we have come across something. For example, I always say that never invest in a sector fund. But at the same time, technology has proven to be a sector which has done exceedingly well over a 10, 15, 20 years period. And it has never seen witnessed a declining phase. And so a combination of technology, Indian technology sector, as well as the international technology sector. And there are investment vehicles. You have the Nasdaq 100 ETF available as an investment option. You have now we have some technology index funds available, and we have the technology sector funds available. So this is one sector about which I feel very strongly that this is something which is becoming mainstream. And they still have a lot of lot of grounds to cover to remain relevant for the economy, and still growing at a fantastic pace.
Today's last question has been sent in by Saurabh Deshpande. He asked, should one buy RBI floating rate saving bonds?
If you are looking for the safest investment, and of course, they get you decent return, and today they look very attractive. And at the same time, if you are looking for an absolutely safe investment vehicle, this is the one. If you are not if you have no other earning, then if it will become a tax-free earning for you simply because you have no other earning, but the interest income will be the only one, then I think for the first 50-70 lakh rupees, this could turn out to be the finest tax saving investment you can earn.
Well, with that, it's a wrap on this episode. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions and keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.